going on, everyone, and welcome back to the Brian Talks Money Show. By now, we all know that the Federal Reserve stayed a course and raised rates by additional quarter percentage and signaled for future rate hikes yet again. The Fed is still not seeing enough cooling in inflation, meaning they are nowhere near their goal of 2% inflation. So even with the banking scandals occurring, it still wasn't enough to stop Jerome Powell from raising the rates to 4.75%, the highest we've seen in decades. But what does this mean for everyday Americans and their money, and what can you do about it? All that and more on today's episode of Here's What the Highest Fed Rates in More Than a Decade Mean for Your Money, which is the name of the article that I pulled up from bankrate.com. So let's get right into it. Today, my goal is to cover who the Federal Reserve is and how they influence your money, especially right now in 2023. The article begins by saying, what is the Federal Reserve? The Federal Reserve is the central bank of the U.S., one of the most complex institutions in the world. The Fed is best known as the orchestrator of the world's largest economy, determining how much it costs businesses and consumers to borrow money. Cheap borrowing costs can be the difference between businesses choosing to hire new workers or make new investments. Expensive rates, however, can cause both businesses and consumers to pull back on big-ticket purchases as well as hiring. Your job security, your portfolio, your debts, and the direction of the economy are all subject to the Fed's influence, says Greg McBride, CFA Bankrate Chief Financial Analyst. As the price of money changes, it ripples out to a lot of different directions. It impacts the health of markets, the amount of money that flows in the economy, and the prices of assets at the household level. Basically, the Federal Reserve is their own entity and is in charge of setting monetary policy that affects virtually anyone and anything that utilizes money. But moving along, the main emphasis of this article is the main 5 ways the Fed influences and affects your finances, from savings and your investments to buying power and your job security. Yeah, I guess you can say they're kind of a big deal. Number 1, the Fed's decision influences where banks and other lenders set interest rates. Higher Fed interest rates translate to more expensive borrowing costs to finance everything from a car and a home to your purchase on a credit card. That's because the key borrowing rate benchmark that influence some of the most popular loan products, the prime rate and the secured overnight finance rate, or SOFR, follow the Fed's moves in lockstep. When rates are higher, the availability of money in the financial system also tends to shrink, another factor making it more expensive to borrow. Sometimes rates even rise on the mere expectation that the Fed is going to hike rates. Now, case in point, here's how much more expensive it's gotten to finance various big ticket items this year after 4.5 percentage points worth of tightening from the Fed. And make sure you screenshot this or pause the video so you can see the chart and the fluctuations in rates. The article goes on to say, after holding above 7% for 3 consecutive weeks, the 30-year fixed-rate mortgage dipped to 6.74% by the end of 2022. Still, more than 3 percentage point jump in a single year is unprecedented, McBride says. Now, being in the mortgage space myself, 2022 was a year we finally woke up to the hangover after being drunk on cheap money for the last 3 years. Number 2. The Fed's rate acts as a lever for yields on savings accounts and certificates of deposits, aka CDs. The article mentions, you might not be able to borrow as cheaply as you used to, but higher interest rates do have silver linings, especially for savers. Banks ultimately end up increasing yields to attract more deposits. The caveat, however, is yields hardly ever rise as fast or as high as the Fed's interest rate. Traditional brick and mortar banks also hardly need deposits, especially today. Now let's take a look at this graph. The average saving yields over the past year has risen from 0.06% to 0.23% as of March 15, according to the National Bankrate data. Meanwhile, a 5-year certificate deposit was paying an average of 0.27% yield 1 year ago. Today, it's offering an average of 1.22%. Basically, right now it might make more sense to invest a portion of your money into a high-yield savings account. But can you really even trust the banks right now? Okay, let's keep moving forward. Number 3, the Fed's rate decision influences the stock market, meaning your portfolio and retirement accounts. Oh man, it's been a rocky road for all investors the last 12 months with volatility soaring all over the markets. But let's see what the article mentions about this. Cheap borrowing rates often bode well for investments because they incentivize risk-taking among investors trying to compensate for a lackluster returns from bonds, fixed income, and CDs. On the other hand, markets have been known to choke on the prospect of higher rates. Part of this is by design though. Essentially, the US central bank zaps liquidity from the markets when it raises rates, leading to volatility as investors reshuffle their portfolios. The Fed made it very clear that at their last meeting that they need to see more softening in the labor market, which is just a nice way of saying they need to see more people lose their jobs. So until then, we can expect rates to continue to rise. Now, it's never been a better time to give yourself a financial audit of your personal finances and really get clear where you would like to be financially in the years to come. The planning must begin now. The article mentions this about long-term thinking. For those reasons, it's important to keep a long-term mindset, avoid making any knee-jerk reactions, and maintain your regular contributions to your retirement account. When the Fed raises rates, that's mostly to make sure the financial system doesn't derail itself by growing too fast. So just keep calm and continue investing as regularly as possible. And think about it like this. The article mentions, low rates are like candy to investors, and keeping rates low is like asking the Cookie Monster if there should be more cookies, McBride says. Mom and pop investors should focus on the bigger picture. An economy that is growing is conducive to an environment where companies will grow their earnings, and ultimately growing the economy and higher corporate earnings are good for stock prices. It just might not be a smooth road between here and there. So don't take it with a grain of salt. I recommend, if you have no idea where to begin, you sit down with a professional financial planner and map out a plan that will help you reach your financial goals. Okay, moving on to number 4. The Fed is one of the main influences of your purchasing power. The article mentions, the Fed's interest rate decisions are bigger than just influencing the price you pay to borrow money and the amount you pay to save. All those factors have prevailing influence on the economy, and for consumers that also means purchasing power. Low interest rates intended to stimulate the economy and juice up the job market can fuel demand so much that supply can't keep up. Exactly what happened in the aftermath of the coronavirus pandemic. And all of that can lead to inflation. But higher Fed interest rates are the fastest way to weigh in on those price increases, though it's important to point out that consumers won't immediately feel an impact. The Fed can't drill for oil or produce more food. All they can do is weigh in on the demand so much that it balances back out with supply, leading to a lower pace of price increases. My personal view is that we are most likely going to feel more pain before we start to see a positive turnaround in the economy. And for what the Fed mentioned, we can expect that to happen sometime in 2025, for now. Number 5, did you know that the Fed influences how secure you feel in your job or how easy it is to find a job? Yup, let's see what the article has to say about it. One of the biggest corners of the economy impacted by higher interest rates is the job market. Expansion that seemed wise when money was cheap might be put on the back burner. And new opportunities made possible by low interest rates are no longer on the table. That has implications for more than just businesses. Individuals seeing new opportunities vanish might start to feel insecure about their positions. Instead of job hopping to a new company, they might decide to stay put. Keep in mind, the Fed needs unemployment to rise in order to help bring inflation down. But let's keep reading along. All of these moving parts are becoming more apparent now. Job openings are still at a near record high, but have cooled since the Fed started tightening borrowing costs, falling to 10.8 million in January from a record high of 12 million in March of 2022. The unemployment rate is still at a near half-century low, but the question is, how much longer could that last? Big tech firms, Meta to Amazon, have laid off thousands of workers. Others, such as Apple, have said they're freezing hiring, revealing just how incorporated the economy is. Sometimes a booming labor market can also contribute to inflation. When there's a mismatch between labor demand and supply, companies often boost wages to recruit more workers. Fed Chair Jerome Powell described it as contributing to today's stubbornly high inflation in a March congressional testimony, estimating that almost 3.5 million workers are missing since the pandemic-induced recession began in February of 2020. 8 of the Fed's past 9 tightening cycles have ended in a recession, according to an analysis from Roberto Perli, head of global policy at Piper Sandler. So what does this all mean for Americans and the U.S. economy? Point blank period. Don't fight it. The Fed will do what the Fed will do, and you can't do anything to control that. But you know what you can control? And let's take it from the article. It says, a higher rate environment makes prudent financial steps all more important, especially having ample cash you can turn to in an emergency. Boosting your credit score and paying off high-cost debt can also create more breathing room in your budget in a higher rate environment. Utilize tools to find the best auto loan, the best mortgage for you, and shop for the best savings account to park your cash. Look, bottom line, it's time to make a plan and stick to it for the next 12 to 24 months. You can't predict what will happen with the economy and the direction that rates will move, but you can predict and control your personal spending habits, your budget, and the financial decisions you make in the next 1 to 2 years. So if you want to stay up to date with the latest updates on rates and the economy and what you can do to get ahead in these times, then smash the subscribe button, give this video a like, and in exchange, I'll do the research so you don't have to. But like always, thank you so much for tuning in, and I'll see you guys on the next one.